Recently, I watched this video from the retirement nerds exposing the truth about Roth versus traditional retirement accounts. And while that video has over 1 million views, and I think you should watch it, it's well over an hour long. So in this video, I'm going to break down the math behind this and what they were discussing. Why was this such an intriguing topic? Should you be contributing retirement money into pre-tax funds or with after-tax dollars, and which one makes the best sort of financial sense for you? So let's talk about it. During the video, I had a visualization that I want to kind of share with you so you can kind of see the math behind this as well. So I'm making some assumptions that you kind of know what I'm talking about a little bit here when I say Roth versus traditional. If not, we'll go over it a little bit here with this visual. What we're saying is we're going to start by contributing $10,000 into either account, whether that be a traditional retirement account or a Roth. This could be an IRA or this could be a 401k. And in our example, it's more 401k numbers because we're putting in $10,000. So remember, we're starting with $10,000. That means like maybe we worked at a job or we have a small business and we earn $10,000 of profit in our small business, okay? We can put that money in a pre-tax account, in a traditional account. And if we do so, we don't pay any tax now, right? That's the whole point of it being pre-tax. In other words, we get a tax deduction for it now. So the money we put in is $10,000. Now we're gonna make some assumptions here that we're gonna double our money in about 9 years. In order to do that, you would get 8% growth exactly year after year for that 9-year period. And so you would double your money. That part doesn't matter because whether you put your money in traditional or Roth, you're probably choosing the same investment type. So don't get bogged down by that so much. I'm just saying at an 8% growth rate at 9 years, your money will typically double. So that $10,000 that you put in grew to $20,000, right? But then because it's traditional and you got a tax deduction when you put the money in, you now have to pay the taxes when you pull the money out. And so let's just assume you're in a tax bracket of 25%. Now, currently there is no 25% tax bracket. There probably will be in the future. There has been one in the past. It's 22% or 24%, but just to keep the math simple, let's stick to 25%. So you pull the 20 grand out, you pay your 25% taxes, so you have $15,000 to go spend in retirement, okay? That's the traditional method. Now let's look at the Roth, okay? With Roth, you earned $10,000, but you need to contribute after-tax dollars. So in order to contribute after-tax dollars, what does that mean? That means you paid taxes, right? And so again, let's assume we're in the same tax bracket of 25%. Well, that means we're actually starting off with $7,500, right? 10,000 times 25% is $2,500. So 10,000 minus the 2,500 is 7,500. Now, same assumptions regarding growth rate and the amount of years we have. And so now we've doubled our money. It's now $15,000 9 years later. So we want to pull that money out and we have no tax to pay because we decided to contribute to a Roth account and paid that tax up front. And so your spendable amount, the amount you actually have to use in retirement, is again $15,000, okay? So the point here is no matter how you do the math, no matter what your growth rate is, the amount of years invested, the point is if you start with 10, you're going to end up with 15 no matter how you kind of do this math. If you put in a different amount, it's going to be the same as long as you put in an equal amount in each account. So some people might make the argument, well, why wouldn't I just put in $10,000 into the Roth account so I can have that money grow to 20,000 and I'll have more spendable money if I go the Roth route? Well, sure, you can do that, but that just means the traditional equivalent would have been more, meaning you would have put in more in the traditional dollars, okay? The point here is the math is the same, okay? If your tax bracket stays the same, while you're contributing versus while you're in retirement, and obviously your growth rate and assumptions are going to be the same regarding to how many years you've invested this money, the math is always going to work out the same. So it's not that big a deal. The problem is that's never the case, right? So I want to give you some reasons as to why you might want to choose one versus the other? Meaning, why would you want to choose maybe traditional over Roth or Roth over traditional? Okay. Because the reality is your tax brackets are going to fluctuate and change, and no one knows the future, and the government might change the tax brackets for sure, right? Everyone knows that we can't keep these lower tax rates forever, especially given the amount of inflation that we have and blah, 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 the deficit, yada, 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 right? So let's talk about these 4 reasons to consider one versus the other. And they talk about this in the video, so I want to give them credit where credit is due. So reason number 1, if you know that you're going to be in a lower tax bracket in the future, then choose traditional, right? The reason for that is you're going to receive a tax deduction now while you might be in a 32% or 37% tax bracket, and you may be able to pay taxes at a much lower tax bracket. Let's say maybe 12% might be your rate in retirement, okay? So that's reason number 1, where you might want to choose traditional versus Roth. You're in a higher tax bracket now, and you know that you're going to be in a lower tax bracket in the future. Conversely, it's the opposite of that, right? If you know that you're going to be in a higher tax rate in the future, it will make sense to choose Roth now. You'll pay taxes at a rate of, let's say, 12% or maybe 22% now while you're in that lower tax bracket, but you'd be avoiding paying taxes at that higher marginal tax rate of perhaps 24, 32, or even 37%, okay? So that's why you might want to choose to do Roth now. You're in a lower tax bracket now and will be in a higher bracket in the future. Now, the third reason would be if you've got a really good reason to just absolutely crush it and get the most amount of dollars possible in your retirement account, then you're going to choose the Roth account. The reason for that is that if you choose traditional, the money that you contribute is not all yours, right? Meaning you're going to have to split some of that money with the government when you pull it out, because you're going to make the contribution at a pre-tax amount. So when you pay it, you're going to owe the government some money. Okay, so you're in sort of partnership with the government at that point. So in this case, it may be best to go Roth because you know for sure how much you're contributing. Because when you put that money into a Roth account, that money is 100% yours since you've paid the tax on it up front. Now, the fourth reason is quite interesting. And so if you're undecided, you're thinking about this, you don't know, right? No one has that crystal ball. You don't know the future. You want to give yourself some options in retirement. Then you could just contribute to both now, right? Both the Roth and the traditional. So for example, let me break this down for you. In 2024, you can contribute $23,000 into a 401k. And so what you could do if you wanted to is split that between Roth and traditional. So you could do 11,500 Roth, 11,500 traditional. And by the way, I haven't really mentioned this before, but my name is Navi Maraj. If you're watching for the first time, I'm a CPA who teaches normally entrepreneurs how to save thousands of dollars in taxes. And I do that here for free on social media, but I also do it through a course, which you can find the details about on my website. That course is, again, designed for entrepreneurs, where I teach you not just the tax strategies, but bookkeeping, how to implement all the strategies using QuickBooks software. I teach you the basics about accounting, basics about tax, how S corporation taxes work, all that stuff, and essentially converting you from an entrepreneur who knows not a lot about, accounting and taxes now, and giving you just enough information so that you can take control of your future and turn you into a tax-savvy entrepreneur who saves thousands of dollars in taxes. So again, you can find out more about those details in my course. The reason why I mention it now is because in 2024, there's actually ways that you can contribute to a solo 401k and put in over $70,000 or almost $70,000 into a Roth account in a single year. In fact, you could do over $70,000 if you combine sort of the mega backdoor Roth strategy with the backdoor Roth IRA strategy. Again, might be foreign terms to you. You can check out the course for more details. Bottom line is, if you want sort of like a free preview of what's kind of talked about in the course, you can watch this other video that I created about the mega backdoor Roth IRA and how to get over $60,000 or even $70,000 in some cases into your retirement account in Roth dollars in a single year. Anyway, let's go back to my original point here, which is that if you have a 401k plan at your employer, it's highly likely that the amount you're contributing, let's say it's Roth dollars, that money, of course, will be with after-tax dollars, but the employer match is with pre-tax money. So you're kind of doing both right now, and maybe you're not aware of it. And yes, I'm aware that there's recent law changes which allow employer to match with the after-tax dollars, or in other words, like with Roth dollars. But I haven't really seen an employer take action on that just yet because it's a little bit complicated how they're going to do the accounting behind that. But the point here is that if you give yourself sort of maximum flexibility with contributing Roth dollars and traditional dollars, it is possible, if you're a married filing jointly couple, to take out $80,000, sometimes even $100,000 in retirement and stay at or below a 12% tax bracket. And if you're wondering like how in the world is that possible, it's because of the standard deduction, right? Which is like almost $30,000 now. So you don't pay any tax on those dollars. You can pull some money out of your Roth account, and you can even have some money in sort of like a brokerage account and pay those more favorable capital gains tax rates, okay? And for those of you who don't know, there are 0%, 15%, and 20% capital gain tax rate. So you need to do some sort of retirement planning and tax planning in your retirement years as well. This is not something that you do just in your working years, but in your retirement years as well, to determine, hey, if I need to buy a vehicle or incur some expense to remodel my home or something like this, you need to speak with either a financial advisor or your CPA and discuss, well, how should I pay for this? Should I pull that money out of my Roth account? Should I pull it out of my traditional account? Should I take it out of pension? Like, what should I do? Because if you take it out of a traditional account, all of a sudden, you might be bumping yourself into a next tax bracket, right? And so maybe those capital gains tax rates that you sold some stock on or what have you, that you thought were going to be taxed at a 0% are now taxed at a 15%, okay? So you've now just paid a lot more income tax on the money that you pulled out of your retirement account. But the major point is really this, and that is give yourself some options. Think about this decision. Don't just blindly contribute to a Roth account because everyone in the world talks about the Roth account, and don't blindly go into a traditional account either. If you want to give yourself maximum flexibility, then perhaps do both. The moral of the story is there's a decision-making process that needs to happen here. The higher your tax bracket is now, chances are traditional might be the right way to go for you. And if you're in a lower tax bracket now and think you'll be in a higher tax bracket later, then maybe Roth is the right way to go. But everyone's situation is different. It might involve your spouse as well. So please consult with your tax professional to get more advice on this topic. So thanks so much for watching. If you want to learn more about those strategies that I talked about earlier, it's not just the solo 401k, but also hiring your minor children, home office, cell phone, internet, all those things, right? How to maximize your deductions in your small business. If you're an entrepreneur, check out those details. My website is navimarajcpa.com, and you can find out everything there. If not, I'll either see you in that next video. Again, you can check out the video where I talk about the mega backdoor Roth IRA, or if not, I'll see you inside of the course.